From President Donald Trump's tariffs to AI investments, markets are at a crossroads. Could these non-stop changes signal a major economic shakeup? Let's get more details now. We're joined by David Scutt from StoneX to break it all down. Great to see you.
Great to be back, Aaron.
Yeah, for sure. Now, talk to us about the impact the trade war narratives are having on global financial markets. Obviously, as soon as Trump made this announcement on Air Force One about steel, had a very sudden impact on the ASX.
Sudden impact, but then it kind of diminished over the course of the session, and then we saw across Asia, and then we saw into the overnight trade as well, just diminished over time, and we're seeing that increasingly at the moment. A lot of the narratives that you're hearing in the media, or you're hearing from analysts like myself, is all being driven by the price action. And that's being honest. And right now, the price action has been pretty tame. And a lot of that comes down to what's going on in the bond market. The bond market is pretty relaxed with the entire a picture here about what's going on when it comes to the tariff threat. Looking at this right now, this is the US 2-10s curve. Basically the differential between US 10-year Treasury yields and US 2-year Treasury yields. And you can see that's flattening right now. And that's partly a consequence of that tariff threat. Potentially higher inflation at the front end of the curve, at the back end of the curve, slower growth, slower inflation, and lower interest rates. So it's already having an effect in the markets.
So when we look at this chart, what is it exactly we should be looking at?
What it's telling you is that basically it's a measure here of those two differentials in yields. And the fact that it's going down now and it's starting to flatten out, it's still positive. It's telling you that markets are starting to go and trim their expectations for growth and inflation, more importantly, in the future. And then when you go and apply that across the markets, it means lower interest rates as well. That's what the market is saying right now. So at this point in time, tariffs, there's certainly an inflationary impact at the front end of the interest rate curve. Overnight rates and the like, longer term time horizon, it's helping to go and diminish expectations for growth and inflation.
And also when we talk about the 10-year yields, reflecting the impact of Trump's policies on borrowing costs as well.
Yeah, and that's where the kicker is at this point in time, because Scott Bessent, the newly appointed Treasury Secretary in the United States, has made it clear that rather than try and sort of focus on overnight interest rates, which the Federal Reserve can control, they're much more interested in controlling the back end of the curve, particularly the 10-year benchmark yield, because that's linked to mortgage rates in the United States, borrowing costs for corporates. So it's a much more influential part of the curve. And right now, it's really suggesting that there's some confidence there going that with the prospect of tighter monetary policy from the Fed and then some cost-cutting measures coming through from the Department of Government Efficiency being led by Elon Musk, that there might be a case to go and actually slow down the economy a little bit further, which would help to lower that rate as well. So it's a real counterbalance to that tariff threat right now.
And the US Treasury yields in predicting economic shifts as well?
It is right now, and at this point in time, we're seeing at the front end of the curve, there's a lot of expectations that the Fed may not even need to go and cut rates again this year. Economic growth is holding up very strong, above trend. Inflation is still obviously a threat. Over time, though, that's expected to go and diminish, and that's where the interest rate mechanism kicks in. The slower the growth, the slower the inflation, the likelihood of lower interest rates as well, and that's what the Trump administration really wants to go and see. They want to target that 10-year part of the Treasury curve.
Yeah, obviously there's a lot of hope that we are going to see some big changes for, the Fed Reserve in America with interest rates. In Australia, we're talking about the RBA as well. What do you think the current environment looks like for both of those countries?
For the Federal Reserve, there's around about a cut and a half priced into the curve this year. And the way that I liken that is that it kind of comes across as emergency cuts being priced in by the market, just in case something happens, an insurance policy as such. But realistically, there's no need for the Fed to go and do anything whatsoever right now until they have greater clarity on the tariff side of the equation, the government efficiency drive that's going on. Here locally in Australia, it's a little bit different kettle of fish. You can make the case that there's no need to go and cut interest rates, but the RBA has made it really clear that they want to protect gains in the labour market. And with that, and given the fact that we're seeing inflationary pressure start to come off the boil a little bit and a little bit faster than the RBA expected, I think it's very, very likely that the RBA will begin its easing cycle this time next week.
Now, we talk about Donald Trump, obviously, and we're looking at Doge and a lot coming out there. Do you think the market could be overestimating the powers that the president actually has, given what we're seeing with the courts?
That's one area that obviously a hurdle that there's a bit of uncertainty about. But in principle, the idea of what's going when it comes to the government efficiency drive and the fact that they're going and saying to some public sector workers, we'll go and pay you out for 8 months to go and voluntarily make yourself redundant. That's all part of a drive to go and try and strip out costs and strip out demand coming through from the public sector. And that's all part of that drive to go and lower interest rates. There are a lot of hurdles there, and there are risks as well, because if you go and cut too aggressively, that leads to the potential that you might not get an economic slowdown, you go and get an economic downturn. And that's exactly what Trump doesn't want to deliver. So it's a fine balancing act that needs to be adhered to here.
Let's have a listen to President Trump talking about the court action.
A couple of court losses, Mr. President, and J.D. Vance said judges aren't allowed to control the executive power. What's your take on that?
Well, we're going to see what happens. We have a long way to go, and we're talking about fraud, waste, abuse. And when a president can't look for fraud and waste and abuse, we don't have a country anymore. So we're very disappointed with the judges that would make such a ruling. But we have a long way to go. We have to find all of the fraud that's going on. We have tremendous fraud, tremendous waste, and tremendous abuse, and theft, by the way. And the day you're not allowed to look for theft and fraud, etc., then we don't have much of a country. So no judge should frankly be allowed to make that kind of a decision. It's a disgrace.
It is just such an extraordinary time, isn't it? How are you guys keeping up?
It's difficult. I can tell you that markets are the way that traders have to go and respond to it as well. I've been doing this for more than two decades, and I can tell you that because Trump's presidency and the way that he operates, I'm already shifting how I go and approach trade setups and the like. Clearly, a lot of volatility at the moment, and what we're seeing in the marketplace is that not only is there volatility, there's dispersion going on underneath equity indices across currencies and the like. It feels like we could be at some sort of turning point. Now, what turning point that is exactly right now, I think it's too early to go and tell, but there's a lot of indecision in the price action, and that's generally what you see around those big sort of macro turning points for the economy and market. So the next few months, I think, is going to be pretty exciting if you're a trader and an investor.
Oh, absolutely, and a journalist as well, I might say too. Talk to us, David, about Jerome Powell's testimony and influencing market expectations, particularly after that CPI report.
Yeah, look, Jerome Powell's on Capitol Hill over the next couple of nights, reporting to both the House and the Senate. He's going to get bombarded with questions about the tariff impact on monetary policy and the like. If you've listened to any of his commentary recently, he's just played the straightest of straight bats. He could go and open the batting for Australia right now in the Test cricket. He's been that reliable on that front. I'm actually more interested in what he has to go and say on his second appearance on Wednesday, because just before he starts speaking, we'll get the US CPI report for January. And he's been showing some signs that he's pretty happy with progress in the inflation front right there. So depending on what the detail is coming through, that's going to be the one to go and watch. I think tonight's just going to be a lot of bombardment about questions about tariffs that he's just going to go and block away consistently.
He's not going to want to talk about government policy at all, otherwise his head might be on the chopping block as well. Now the ASX 200 moving on technicals rather than fundamentals. Do you think investors should be adjusting their strategies right now?
Yeah, maybe not adjusting the strategies, but what we're seeing at the moment is that at an index level, you can see this is looking at the 200 futures chart for ASX, and you can see it's just in a rising channel. And every time it gets into that channel, it's been bouncing recently, and that's been driving a lot of the price action. It doesn't make for kind of sexy ideas as to exactly what's driving the market and the like, but it just reinforces to me that a lot of the noise about reporting season and everything else from a macro perspective is not really that important. At the single stock level, it's definitely going to be important. But from a macro perspective, I don't think it's going to really upend the boat when it comes to the trajectory for the broader index.
Very much so. I mean, the ASX obviously it's kind of been watching what's happening in America and in China with a bit of uncertainty, but still it's been posting some record highs.
It has been, and that's part of the RBA rate cut hopes that are priced into the market now. A couple of cuts priced in for this year, at least. Then also you just have the markets seem pretty relaxed about what's been going on across the tariff front, Trump's policies and the like. I think we're coming a little bit immune to that right now. And the big factor that doesn't get anywhere near enough attention is the level of the Aussie dollar, both against the US dollar and in trade-weighted terms. It's sitting very close to multi-year lows. And the translation effect for those offshore earners is clearly positive on that respect. So to me, when you look across not only the ASX, but some of those European indices and how weak the euro has been, a lot of it comes down to currency translation as to why they're outperforming so much at the moment.
All right, makes sense to me. David Scott, appreciate your time. As always, great to have you back on Ticker. Thank you.
Great to be here, mate. Take care.